Good morning, everybody. Thanks very much for joining us. Really interesting discussion here, looking at Italy and covering some of the key sectors. So great to have your I suppose questions and comments as well. One of the joys of this being live is that we can pick up on your views. For those who don't know me, my name is Richard Betts. I'm the publisher at Real Asset Media. We publish Real Asset Insight, Real Asset Impact, looking at the ESG and social impact side, and run around sort of 70 to 80 of these events a year, both online but also in person at Expo Real, at MIPIM, and across Europe. Great to have Giacomo Mori and Marco Grassadonia here. Let's just start with some quick introductions. Giacomo, just a brief introduction from you.
Thanks for inviting me. First of all, my name is Giacomo Mori. I'm Associate Professor of Practice and Faculty Deputy for Corporate Finance and Real Estate at the Bocconi School of Management. Bocconi is the business school of Bocconi University. It was founded in 1971, so more than 50 years ago. And we are very proud to be ranked by Financial Times as the 4th business school in Europe. And we have several master programs, open executive programs, and we provide also tailor-made courses for companies, as well as applied research. My field of research is mainly finance applied to real estate.
Perfect. Thanks very much. Over to you, Marco.
Thanks, Richard. Thanks, Giacomo. And a very warm welcome to everyone who's attending this webinar. It was to make a short introduction on Garbe Group and our activity in Europe and in Italy. I will condense in 1 minute, I promise. My name is Marco Grassadonia. I'm country head for Garbe Industrial Real Estate and Garbe Institutional Capital, 2 companies of our group. Garbe is an old family business with over 55 years of experience, with a very solid stakeholders and a stable management. This allows a long-term vision and also the possibility to build a long-term relationship with investors and partners. And with all the companies of our group, we have more than 350 employees across 10 different jurisdictions. And we invest and manage in several asset classes: logistics, science and tech, residential, commercial. And actually, we have an AUM of over 13 billion euros of real estate. What is really important, and this is the only thing that I want to show on the slide, is that we know that management of funds of behalf of institutional investors cannot be separated from careful and continuous ESG policy. That's the reason why ESG is the center of our portfolio management, investment management. The idea of Garbe is to create a 360-degree integrated platform in order to follow the entire life cycle of investment in real estate. So Garbe is a fund manager, is a development manager, is investment manager, is portfolio manager, and is also property manager. So we can say that's true for our investors, that they will never walk alone. And this, I think, is a great advantage for them, because this allows in good times to create additional value, but also, and especially in a moment like this, to preserve value and cash flow in bad times. Just 2 words regarding Italian activity. We started 1 year ago, so we are very young, but thanks to the great Italian team in the first year of activity, considering standing investment development, already bought properties and secured assets, we already deployed almost 400 million euros total investment value in this country. And just to complete and come back to ESG, just 2 examples of the last transaction. We bought 140 40,000 square meters of logistic portfolio, standing portfolio in Italy. 2 of them are BREEAM new certificate, the other 2 are LEED Gold certificate. And on the development side, we just started tier 83,000 square meters development site logistic facility near Milan that we aim to reach LEED Platinum certification. Promise I try to be very short, so I leave back the stage to you, Richard.
Great, thanks very much, Marco. Yeah, really interesting. And we're going to have now from Giacomo just a sort of brief overview of the economy, but also, I guess, of politics and the real estate markets. So over to you, Giacomo, in terms of giving us that sort of brief overview, and then we'll be able to dig down into the discussion. So over to you, Giacomo.
Okay. Well, I will go very quickly on 2 points, an overview of Italy and a snapshot of the Italian property market. Italy is a country that is very heterogeneous, so it's important to go deeper on some points. I will touch a few of them. About geography, Italy represents 8% of population with 59 million inhabitants out of Europe, on a surface only of the 3% of the continent. So the density, 195 inhabitants per square kilometer, is more than the double of the European average. So this is a first point to keep in mind when looking at Italy, because it's a dense country with limited supply of land. In terms of GDP, Italy still represents the 8th economy in the world, with a GDP estimated in 2021 around 1,782,000 billion euro. That is around 30 euro per capita. This means apparently that it's well below the European average, with Germany 43, France 37, and Spain 25. But we have to go deeper on this point, because different regions of the country have different GDP per capita, also very heterogeneous on this point. In terms of forecast, 2022 is expected to be a good year, with an increase by 3.9% compared to the previous year due to the pandemic rebounding, but also to some good choices of the government in terms of support to the economy. Also, 2023 will be a positive year, but of course, doing forecasting this period is very hard due to a lot of factors like unexpected inflation, Ukraine war, supply chain disruption, and other elements that are common to other countries. Another point I would like to touch is unemployment. Unemployment rate is 9%, above European 27 average of 7%, but also this data should be carefully analyzed, and we'll come on that later. The same for debt. Government debt is 2,742 billion. That is a huge amount per capita, 46,000 euro, or even better to understand, 150% of GDP. This is close to the double amount of the European average, 82%. But if we don't consider also the private indebtedness, it's difficult to understand the real situation. If we look to private debt on GDP, Italy is just 43%, well below other main countries in Europe like Germany with 56, France 66, and Spain 57%. Another point that is important to look at is the administrative organization of the country, that is divided in 20 regions and 107 provinces. But even more important is to highlight that there are 7,904 municipalities. The point is that every municipality has different rules in terms of zoning, building permits, and all the rules related to real estate development. So this means that it's important to have a very deep local knowledge in order to be able to develop and operate in real estate in a wide sense. Last but not least, I would highlight also that Italy is the country with the highest number of World Heritage sites according to UNESCO, with 58 sites. The second country is China with just 56. And this is an important point to keep in mind, because hospitality sector has a lot of potential that, in my opinion, is not fully exploited yet. Now, we go deeper on some of these points. First of all, as you may see from the map, Italy is a dense country with most of the people living in three main areas: the eastern coast, the Adriatic Sea, the western coast where Rome and Naples are, so that area is very dense, and also the northern area with the Pianura Padana, the large plain in northern Italy, where most of the largest cities and people live. So this means that it is a country with a limited supply of land, because there are two important mountain chains, Alpi and Apennines, that limit the supply of available land for agriculture and also for living. This means that the supply of space is limited, and this contributes also to keep the real estate market stable over time. Coming back to the second point, GDP, as you may see again from the map, there is a huge heterogeneity in the country, with some regions in the south with very low GDP, well below 65 out of 100 in terms of PPS, but other regions in northern part, including Lombardy, have GDP per capita not different from a richer area in Europe. If you look at Lombardy, it's classified among the richest area of Europe. The same analysis should be run for unemployment. 9% is well above the Euro 27 average of 7%. But if we go deeper in this analysis, we can see that 4 out of 5 regions in Europe with the highest unemployment rates are in Italy. And if we go back again to the map, we see that the northern part of Italy has an employment rate that is not so different from France or Nordic countries. In terms of productivity, it's important to keep in mind that in the last 20 years, Italian productivity has not increased too much. Better, according to the real GVA per employment, it is slightly below the 100 index point of year 2000, compared to 10–15% increase in other larger countries in Europe. But again, if we look at the real GVA per employment and quality of structural characteristics, we see such a huge difference between different regions in Italy, with a very high productivity level in the northern regions. Again, coming back to the debt, we see a huge increase in debt stock, and also as debt stock on percentage of GDP in the last 20 years. That is one of the main trouble in Italy, but we have to come to the second part of the point, with a private debt well below the average of other European countries. Again, if we look also at the cost of debt, the cost of debt in the last few years has been reduced due to the quantitative easing that affected all the markets. But if we look also at the forecast about the average cost of debt in the next 5 years, the amount is still relatively low, due to the fact that a lot of bond has been issued in a period when interest rates were low. Finally, if we look again at private debt, we see that both households and non-financial corporation net inflows has been positive in last 3 years, also due to the pandemic effect that is contributing to an overall debt reduction. Let's enter now in the real estate market, but before talking about figures, I would like to highlight a few features of the market. First of all, it's a relatively recent history because we can say that a big change in the market occurred at the end of the 90s when Italy entered the euro and the Italian lira currency risk disappeared. This allowed a lot of foreign investors to pour huge amount of money in the real estate market in Italy, and together with money, they brought also a lot of new competencies that contributed to create a professional market. Not only, at the end of the 90s, the government instituted a law for real estate funds, regulating funds that has been very important for the following years. If we look at investors, it's also important to mention that there is a lack of listed companies. Even if in 2007 a REIT regime law has been introduced, currently only 5 companies applied to this regime, and they account for less than 1 billion euro market cap overall. So it's a very limited market. Most of the capital are private capitals, mainly from private equity funds. Overall, the assets under management of Italian regulated fund accounts around 120 billion euros. Most of this capital comes from international players. If we look at the assets, first of all, there is a limited availability of investment grade assets. One of the reasons is that the country is made of small, medium enterprises that typically own their own properties, and the market for offices is mainly limited to larger cities as Milan and Rome. Again, also the hotel sector, that is very important, is the largest by number of keys, is very fragmented, and it is characterized by local operators. Finally, it's important to say that the residential sector is mainly owned by families for their own use, but also as investment. So there is not so far a professional residential investment market. So private rental sector is at its starting point. If we look at the capital inflows, Italy is now the 5th country in Europe, so it doesn't reflect the size of its economy. But if we look also at the investment volume evolution, we see that also the Italian market has been hit by the global financial crisis, and even more severely by the Italian government debt crisis of 2012. After that period, also pushed up by quantitative easing, investment volume has increased a lot, reaching the peak of 12 billion euro in 2019, and it's expected to be even higher in the current year. If we look deeper, we see that most of the capital is from foreign investors. We look at 70% as average in the last 5 years and 75% in the current year today. A quick snapshot of yields. Yield rates has been stable for quite a long period, but also in Italy, the quantitative easy effect contributed to a yield reduction. What is interesting is to look at the yield compression in several sectors, except for shopping centers that has been hit by e-commerce also in Italy, and the deep reduction of yield rates for logistics. Now things are quite difficult to forecast because, of course, the raise of interest rates will change the market. We will come deeper on this later. Look at office. Office still represents the most important segment for investment. We see yield rates very low for Milan, a little bit higher for Rome, but both markets have been increasing due to the free risk interest rate increase. Most of the capital comes from European investor, but also United States and United Arab Emirates account for an important role in the market. If we look at the lease market, we see that the rental level has been stable in the last 3 years, but also due to the lack of high quality ESG compliant properties, prime rents in all the markets, in all the sub-markets of Milan and Rome has increased. Milan and Rome are different in terms of clients. Milan is mainly a market of private companies. Rome is also a market for public institutions, so the market is typically more stable, but also the rental level is lower. If we look at retail, as in any market, we see a reduction in real estate investment volume because many investors are skeptical about this segment. But if we look deeper at prime yield, prime shopping center and retail parks had just a slightly increase. The real effect has been on secondary shopping centers whose yield rate skyrocket. If we look at high street retail, the yield rate has not changed too much in the last few years. The same for rents. Good shopping centers rental level has been stable, notwithstanding the e-commerce effect. But if we look at high street retail, we see still a strong interest of luxury brands to have retail points in the main street of Milan, Rome, and other touristic cities like Venice and Florence, with rental level still quite high and in some markets still increasing. Of course, e-commerce has a strong effect, but as you can see from the map, e-commerce penetration in Italy is well below the European level. So we think that there is still quite room for improvement of e-commerce with an additional effect on traditional retail and a push up in the logistic market. If we look at the map, we can see some major markets in the northern Italy already developed, but also some emerging logistics market in some strategic region in the center and southern Italy. Logistic take-up evolution has increased in the last few years, and especially if we look the last part of the chart, we see that investment volume has skyrocketed in the last 4 years. The reason is also that there is a lack of modern logistic warehouses, so also development activity in this segment is quite high, but development activity is also limited by supply of land and also by local rules that are quite complex, and it takes time to complete development projects. In terms of compounded average growth rate, we see that the investment has increased by 31% per year over the last 5 years. So the level of investment is now relatively high, one of the highest after office segment. And now let's move to conclude to hospitality. Hospitality is becoming an important segment in Italy. If investment volume on average in Europe is just 5%, in Italy it represents 16%. And we can see that in the last few years, there has been a quite high number of transactions and a relatively high investment volume. What is important to look at is that the market is mainly made of privately owned and managed hotels, so the brand penetration is one of the lowest in developed European countries, 21%, well below 58% of UK, 57% of France, and also 46% of Germany. Last but not least, the two main markets for hospitality, Rome and Milan, are expected to reach again the pre-pandemic levels in terms of visits by 2023 for Rome, so hopefully next year, and in a couple of years for Milan. Final note, in the Rome market, 4 luxury hotels will open soon, providing an additional supply for high-end service level in the hospitality sector. So that's all. Thanks, everybody.
Great, thanks very much, Giacomo. Really, really interesting. Lots of things to drill down there, I think, in terms of the discussion. And Marco, you're just going to briefly give us a couple of views here on the logistics side, obviously from Garbe, but also I know that Garbe's been focused a little bit on the residential and also on science and technology. So just give us a very brief overview on that, and then we'll drill down into some of that in the questions.
Yes, Richard, and of course I will benefit on some hints that Giacomo just told us regarding the Italian structure. So if you can go on slide 3, we can see some let's say hints on logistic market. Logistic market in Italy on 2022 was an exceptional year. Just to give a very simple and easy data, we have a stock of around 21 million square meters of logistic warehouses in Italy, and at the end of 2022 probably we will reach, in terms of traded properties, more than 2.2 million. It means more than 10%, 12% probably at the end of the total stock will be traded. And if we consider, as Giacomo just said, that part of the stock is an old stock, so it's not part of the, let's say, institutional capital markets, this share will be even higher. It's really important to highlight, and I will connect to Giacomo's words, on the fact that Italy is a very small country in terms of surface, so the land is very, very limited. And above all, we have a very difficult situation due to the fact that we have 88,000 municipalities, and for logistic, most of them are sometimes very, very small. So having this very complex, let's say, bureaucratic environment, which is very difficult, is really difficult above all for cross-border investors investing in Italy without being locally, because they risk to get lost or get frustrated from the several and different routes that there are municipality. I don't want to make an advertising on Italian lawyers, but I have to say that from an administrative point of view, they are probably the most prepared in Europe, because they are used, they are all often helpful to support small municipality on their process, because even municipalities itself, they are not prepared to big logistic projects sometimes, and so they need to be driven and helped by the investors itself. Basically, we have in this moment some, let's say, opposite component in the logistic world. Of course, we already said about the interest rate that are raising. This is bring to a more financial cost for each development. We faced a very huge increase on the construction cost. That, of course, is another point that will make more difficult, say, to get the correct results. And on the other side, the increase of Italian bond will bring more attractive for some core investors fixed income. So we have these points that go in one direction. On the other side, we have some very good strength on this market. First of all, as Giacomo said, we have a very low e-commerce penetration so far. COVID gave a boost on that, so we are now trying to recuperate our distance and that we have with the other European countries. It means that we need more logistic facility. Usually it's calculated that every €1 billion of increase on turnover, we need 1 million square meters of new logistic facilities. And as I said, we have a very limited stock. We have a very few surface, and we have some very strict regulations. So it means that the few developments that are allowed to be go alive, they will have a very, very easy rental situation. And go to the directly to the rental level, we are seeing that despite the huge inflation that we had in Italy in these months, almost 12%, so similar to the beginning of 80s, we have rental level logistics that are going over these inflation rates. So we have the possibility to let the asset with final rental value, which is higher than expected in the BP, and this will compensate the negative factor that I've just described before. In terms of region, it's very, very easy. I mean, the northern part of the country is extremely developed. It's extremely rich. We have all the connection with the rest of Europe. We still have, compared to the rest of Europe, a very low rental level, and so very low capital value. Some of the most important retailer or 3PL, they also choose Italy and the north of Italy that is well connected to the rest of Europe to put their South European hub. So it's a very, very strong market. We don't have to forget that we have almost 30 million people that lives in the center and the south of Italy. And if we consider that this number of inhabitants is higher than the Nordics, these inhabitants need to be served in some way. So also the south hub must and shall grow in the next year. Of course, the European program should help on this, above all for the port. So the possibility then for having a directly connection with the islands and with the south of Italy, then to serve the population here. But of course, it will take years, and usually above all, cross-border investors, they do it very, very carefully, this passage from the north to the south. So I think, Richard, I mean, if I don't want to go deeper, but if you want to, I can pass to residential and science and tech, but very, very shortly. I don't want to leave time to the rest of the discussion. So we just give some hints on the residential markets only. So in the next slide, only just to let's say confirm what also Giacomo already said. The residential market is mainly for institutional investors, a market based in Milan. If you go to the next slide, we can see how Milan city is very, very strong in terms of growth of population. Italy, unfortunately, is declining in terms of population. Is a fact now. It is almost 20 years that we are declining, while Milan is expected to grow. Also, households for Milan expecting to growing. Milan has GDP which is much higher than the rest of Italy, and also growth of GDP which is much higher, unemployment rate that is very, very low, and we can see how this has been already reflected in the residential market. If we go on the next slide, we can see how the housing price index for Italy, that's from Q1 to 2010 up to Q2 2022 had say a good performance, or let's say a recovery from the past. We can see that Milan really outperformed compared to the rest of Italy, and this is, as I said, this due to the fact that, of course, we have a population that is growing, young population that is coming in to look for a job, young professional. I think that we have the highest rate in terms of immigration between 25 and 34 years old, and this linked to the lack of products and the limited possibility to develop inside the city. Milan is a very small city, is only 140 square kilometer, if we compare with Rome, which is 1,000 plus square kilometers, is much smaller, and we have 1.4 million of inhabitants. This brings very, very easy to understand how the prices are increasing so fast. But there is a last message that I want to say. Even if pricing are really increasing in Milan, and we can see from this slide, we are still far from the compared city in the rest of Europe. So Milan is much cheaper in terms of price per square meter average residential compared to Munich or Paris or London. Of course, I don't want to to mention, but also the other main EU countries. So that's it's a reason why the Milan market, more than, let's say, the Italian market, is really attractive for institutional investors. And so just few words regarding science and tech, which is one of the most emergent sub segment in the real estate sector. Science and tech is the combination of campus in which office and R&D space will stay together. We have laboratory, production, storage, offices, but even sometimes also small data centers that are establishing some clusters in Europe, and Milan is one of these clusters. And most important, the tenants are the tenants that are working in the growing industries in and the most prominent industries in the next years. As you can see, the attractiveness of life science increased in 2022. So it's the second position together with logistics. So it's really one of the most important trend, and also the annual growth rate is at 23%, which is a lot. It's still a niche market, but this is exactly what we were saying regarding logistics 8 or 10 years ago. So probably this will become a real asset class soon in all the asset allocation for all the real estate investors. I try to speed up in order to avoid to lose time for the rest of the discussion.
That's perfect. Thanks very much, Marco. And really interesting as well, I think, to see how some of what might have been regarded as alternatives are beginning to come through into the mainstream. And that's a discussion that we've been having in a lot of the sessions that we've been running over the past year, for certain. Lots to dig into there. And thanks very much for the questions that are already coming in online. On the right-hand side of your screen, you've got a Q&A and chat button. So if you put your questions in, we'll endeavour to try and answer those. And also you can like them so that you can also then make sure that moves up, and we definitely answer those ones. I'm going to come to a couple of those in a second because there's a couple of interesting ones, but I wanted to pick up on a slightly more kind of general point, I suppose, just starting with you, Giacomo. I mean, obviously 2022, huge change in the markets more widely. So when you're looking at the past 12 months, how do you see the influence on, I suppose, both Italy and the Italian real estate markets?
Well, the Italian real estate market has been very active in the first part of the year, but like other markets, due to the uncertainty of the war and rising prices, inflation, cost of construction, and whatever, the second part of the year has been a little bit more conservative, so lower amount of investment. So most of the investments that we have recorded in the last quarter are due to deals that started in the early part of the year. So uncertainty is the key issue also for Italy.
It would be good to also pick up, Marco, I think, from you. I mean, what was interesting there in Giacomo's slides as well was the investment volumes, the investment activity still happening there. So from your point of view, I guess, Marco, what's driving that more generally, but also specifically, let's look at the logistics sector as well.
Yeah, as Giacomo said, until let's say the market situation was not affected by the war, by the rise of the interest rate, Italy was a really interesting country for all the point that we already said. I mean, it is a country where there is still a great possibility to grow, and this is a market that is now a permanent market for cross-border investors. We have seen that is 75% of the investment are made by in foreign investors. If we look this percentage compared to 2007-8, during the first peak that we had was 80% Italian, 20% foreign investors. So it was a very domestic market. Of course, in this moment, there are some factors that are, let's say, slowing down the activities. The first factor, which is very, very natural, is the difference between seller expectation and buyer expectation. Seller expectation are still linked to the, let's say, 3 or 6 months ago, and buyer expectation are already trying to incorporate also further risk for 2023. So we have to, let's say, reduce this distance in order to make the market ramping. But I would say there are a lot of opportunities. When I was speaking regarding logistics, if we consider that most of the speculative developments are going pre-let before completion, beating what is the business plan in terms of ERV, this will, let's say, reduce much more the risk of the investment. This will secure cash flow also for core investors for long period. This has also secured investors versus the inflation, because all the Italian real lease agreement, I don't want to enter in detail on the law of the lease agreement, but are linked to annual inflation, and is also a cover on the capital preservation, because I said the rents are growing much more than inflation. So basically, even if we lose some bips in terms of yields, we can recuperate it in terms of expected VLD and reversion at the end of the lease agreements when there will be renegotiation. So even if, as I said, there is uncertainty, there are still a lot of opportunities in this market, and say above all in the logistics sector.
Okay, great. I wanted to pick up on a quick question that had come in terms of from Laura. So thanks very much, Laura, for this, which is, are EU funds attracting more international investors? If so, what are the most impacted assets? And if not, why not? And I think Laura there is particularly talking about the PNRR, the National Recovery and Resilience Plan. I don't know whether that's something that you're sort of tracking there, Giacomo.
Well, let me say that is an indirect effect, because PNRR funds will contribute to improve the quality of infrastructures and, generally speaking, of economy in Italy. So this will contribute to attract additional investment, but it's difficult to say which segment will beneficiate the most from this.
And a kind of follow-up question as well from here, which was somebody saying that the challenge they have when investing in Italy is the returns compared to Italian government bonds. So the question is there any support in establishing a justification for them in terms of investing in the real estate side? So I don't know if either of you have a view on that one.
Yeah, but
well,
I mean, Giacomo, it's, I can say from my personal experience investing for foreign investors since 20 years, this has been always a big point. We have to consider that historically in all segments we already had 100% or sometimes in very good times 70-75 bips of difference between Italian prime yields and rest of Europe prime yields. That reflects already the difference between the Italian government bond and the German or Spanish or French bond. So this is something that has been already incorporated in the analysis and in the valuation of the foreign investors. And that's the reason why Italy is usually quite attractive at the end, because at the end returns are always or slightly or bit higher than the rest of Europe, depending on the period of the market.
Okay, good. Giacomo, did you want to pick up on that?
Let me add just a little point about this, that I totally agree with Marco, and I would also add that if we compare property yield rate with treasury bonds or any kind of bond rate, the comparison is not fully correct, because when we talk about yield rate, we consider only the income return component. When we look at government bond yield rate, it's an yield to maturity, so it's a total return. So in a very simple manner, we don't consider any potential capital gain growth in the real estate. So especially in long-term investment with an expectation of rental increase, it's normal that investor would consider also an expected component of capital gain return. So coming back to the point, the comparison between property yield and government bond yield is not technically correct, because the second one is a total return. The first one includes only the income return component. And we know that in real estate, when market is going well, we may have a capital gain return, especially if we look at segments like, for example, high street retail, where income is so low, better income return is currently so low because it may reflect expectation of long-term rental growth.
Okay, interesting. A couple of other ones. I've got some broader points that I want to bring up, but I just wanted to deal with a couple of things that are coming in as well. So we've got a huge topic, obviously, here in terms of ESG, sustainability. So it'd be interesting to get both of your views on that and how that's a driver, particularly for 2023 and for this year. But a question has come in around how do you measure embodied carbon in your developments? So that's one. There's also a question here around CMBS, actually, which is the tail period in Italy is always longer, 7 years versus 5 years for the rest of Europe. Can you comment on asset enforcement timings in Italy? Would you see any changes in this period of time? And another one, which is for you specifically, Marco, which is what's your view on last mile logistics in Italy? And that's from Peter Forster in Munich. So let's see if we can pick up on any of those. And maybe Marco, just pick up on first of all that point on last mile.
With the last mile, of course, last mile is supply chain. Needs to be faster and cheaper for the final customer. This is something that we cannot avoid. So last mile is a really important point for the final distribution of all the goods. And the rising of the e-commerce, this is becoming more and more important and attractive. And considering that in the inside the cities or just in the boundaries of the main cities, the scarcity of land is very clear to understand, and also the conversion is very complex. Say the logistics facility in terms of last mile can only take appreciation in time. I say there is only one thing that we cannot build, which is land. So if we have and we get the best position to distribute goods inside the city and to reach the highest number of population in 30 minutes driving, we can only have an increase of value in terms of capital value and of course in terms of rent in case of reletting of this property. So say last mile is a key point of the final distribution of e-commerce and especially in Italy, small country, high density. It's say a secure investment for institutional investors.
Okay, great. Giacomo, did you want to pick up on any of the other points around the CMBS side or the sustainability side and embodied carbon especially?
Well, I don't have a precise view about CMBS, better about non-performing exposure recovery, because Italian law is quite complex and it's very different, as I mentioned at the beginning, in different regions, since every court has its own time, its own procedure. So it's a quite complex business. So I think it has improved in the last few years, but it's not efficient like in other European markets. So this is also one of the reasons why cost of debt is higher. Coming back to the other point about sustainability, I think sustainability is it's not more a nice to have, but it's a must to have, because it's quite obvious that every sector, I'm not talking about real estate, I talk about every economic sector in general is looking at sustainability deeper and deeper now. So companies require sustainable properties. Investors want to allocate money in a sustainable asset. So I think that the market is going to be divided in 2 or at most 3 categories. The first category are those buildings that is not economically convenient to convert, so they will become brown buildings and later on stranded assets. Those that are developed now that of course will be sustainable and high-end, that will still receive money and get tenants, and something in between that are those properties that is still economic feasible to convert in sustainable asset. But I think we will have those 3 different markets, brown assets, green assets, and something in between where conversion is still possible better. It's economically feasible to convert in green asset.
Okay, good. And Marco, I suppose from your point of view as Garbe, what are you doing in terms of that ESG side, because that's obviously going to be driving, the resilience of the assets in some way.
Absolutely, absolutely, and of course, this is for us is a daily challenge and a daily work to improve this, and this is in different pillars. Of course, we have the existing portfolio for which we continue try to minimize the carbon footprint, implementing managed to green measures continuously, and together with that, it's really important, as just Giacomo mentioned, we have sometimes the needs to demolish the assets. So also the handling of the demolition through recycling, this is really important from ESG component. But we don't have to forget that we have the embodied energy that we have in buildings, and we have to ensure extending at maximum the life of this building. Of course, this will become much, let's say, easier from one side when we go to the development project that we are following. We are mainly go to revamp dismissed area. So starting from brownfield, this will allow us first to improve from environmental point of view the area, but then also to give to the community and to the society, often for a small municipality, carbon zero logistic facility that can also have a high impact on the employment of the people, on the life in benefit for all the municipality, because of course we are doing also a lot of side works every time we build a new asset. But of course all these start from one main point, which is the transparency of data management and the benchmark reports. That's the reason why, of course, we participate to GRESP and all the other important ESG group.
Okay, good. Quick questions just come in, and we're running short of time, so we'll try and be as brief as we can and get through all of these. But Milan residential prices are not yet at EU levels. However, wages in Munich are 50 or 100% higher. How many young professionals will be able to buy a house without eroding the family savings? In the long run, this will weaken the social resilience of our society. What's your view? So I suppose that question around affordability is quite interesting, and the disparity there between Milan and Germany, for example. I don't know who wants to pick that up.
Yeah, I mean, I would say it's a very sensitive point, and it's a very, very good question. We have to say, first of all, that what we are now developing in Italy is the BTR built to rent residential. Starting from one point that we don't have to forget, it's true that our wages are below Munich and the rest of Europe, but we don't have to forget that more than 80% of the Italian people own their house, which is the highest ratio that we can have in entire Europe. And as Giacomo said before, we are a very rich country, not well managed. If we compare the private savings and public debts, we are on the opposite side. But that's the build to rent, of course, is the answer to this. On one hand, above all for the young professional and for the people that go in Milan to find for a new job. We don't have to forget that Milan obliged the Milan municipality, and we go back to the peculiarity of each single municipality. Milan municipality has as mandatory for each new development on residential that is over 10,000 square meters to have a portion dedicated to affordable housing. This is for selling and for rent. So just municipality of Milan is trying to create also a critical mass of available apartments that are for affordable housing. Of course, this is not the final answer, the complete answer, but I think that this is a way that we are following. We can see the result in the next years. And of course, this measure should go ahead with other public measures that have to be taken to allow all the people to have a correct house to live.
Okay, good. There's a couple of last questions. We're very tight for time, so quick answers on this would be good. But interestingly, there's been no questions about geopolitics and the political situation there, because there was a great deal of certainly concern, if I'm looking at the UK and European papers, around the sort of rise of the far right and Giorgia Meloni becoming prime minister. Is that something that is seen differently in Italy? I mean, how do you see that? And I suppose what's the impact more broadly, and does it have an impact on the real estate sector at all?
Well, I don't think the current government, like any other government, and I'm not talking about this specific one, but has such a great impact on real estate market or economy in a wide sense, for at least two reasons. First of all, Italy, from 1948, when the Republic was set up, we had 68 governments. So it's quite common to have governments quite short in time. So I can't imagine such a great changes in the short periods that on average government stand up. Second point, we have to remind that Italy is organized in many different levels of administration, with the regions, provinces, municipalities, with a lot of different items they can manage. And last but not least, even if we had a lot of governments over the last 70 years, the structure of the public sector is quite strong. So it's not the government to change the real situation, but it's also the public sector that still goes on regardless of the government. Last but not least, at the moment, the current government didn't change the previous government policy on very important things like PNRR or other economic reforms. They are talking about less relevant things like the use of electronic payments or the use of cash for payments, all things that I don't think will affect the economy so much in the future.
Okay, interesting. Thanks for that, Giacomo. I think that'll be interesting for people outside the Italian markets to help understand that. We're slightly over time, but I want to finish with one kind of topic, which is, I suppose, what do you see as the key theme for you for 2023? What's the key challenge? What's the key opportunity? Where should people invest? So difficult to round that up all, I know, in one go. But let's maybe start with you, Giacomo, just in terms of, key themes. What should people expect? And I suppose, where are the opportunities?
I think logistics is still interesting because there is still lack of supply of new properties. So logistics will remain a good asset class to invest, I think. I think also hotels will be interesting because I really believe in a recovery of tourism, and this may be a great advantage for Italy. And I would keep eyes open on last mile logistics as well as data center, life science center, because I don't think there is such a good supply yet. And last but not least, if we look at life science, this is like office, but with the difference that is not affected by smart working.
Mm-hmm.
Interesting. Great. Marco, over to you.
Yeah, no, yeah. I mean, I fully agree with Giacomo. I see in logistics and science and tech a lot of opportunities for the next year. I see also in the residential market in the selected cities where we have in the north part of Italy, and then we have also universities, because we have also a lack of student housing, which is a sub-segment that we didn't treat it today, but we have for sure room in to improve to increase in the next year. So say logistic, residential, science and tech with also sub-segments below, last mile for logistics, and keep an eye on data center, which is for sure a booming market. A little bit complicated in Italy because we have to deal with public entities for the energy, so it's very complicated, but it's a market that can give good results for investors.
Great, and I'm sure that complexity is also added to by the fact that there are, you know, almost 8,000 different municipalities, which must be a planning headache, I would imagine. Really interesting to pick up on your views on the market. The next event in this series, where we're working with Garbe, looking at different markets, is going to be on the 25th of January 2023, and we'll be looking there at the French real estate markets. The presentations from today will be available on the website to download, and this recording will also be available on demand, so do feel free to pass that on to everybody. And if you are watching this on demand, thank you very much for watching. Thanks very much, Giacomo. Thank you, Marco. Our next session is actually tomorrow morning, where we'll be looking at new energy, green energy, sustainable energy. So picking up both that infrastructure side as well as the real estate side. And it's been noticeable, actually, quite a lot of investment in Italy, particularly on the solar side recently. So interesting to see that as an alternative sector growing as well. Thanks very much, Marco. Thanks, Giacomo. Thank you for joining us, and look forward to seeing you the next one. Thanks very much, everybody.
Thank you, Giacomo, and thank you.
Thanks.
Bye.
Thanks for inviting.